Welcome, everyone. My name is Matt Morrell. I'm the Retail Lending Sales Manager here at Chelsea Groton Bank, and I want to welcome you to the Power of Credit. We're going to go through the slide deck to give you a good overview of how credit works and do's and don'ts about maintaining a healthy credit score. So I told you who I am. So let's just move right along. We're going to cover credit. We're going to cover your credit reports, myths, common misconceptions about credit, what to do and don't do to maintain a high credit score, how credit scoring works. So a little test of knowledge. Having access to credit is a consumer right, true or false? That is false. Like I said, it's a system that has been made up over time, but we don't start with great credit and keep it great or ruin it. We start with no credit and we have to build it. And that's the idea behind this question. You need to earn your credit. Like I say, we all start at zero and we build it. It's kind of like the SATs, you know, putting your name on the paper when you're in high school gets you a minimum grade, but then you have to answer the questions correctly and build it from there. So what is credit? Credit is anytime you borrow and a record is made of your behavior with that loan or that line of credit that you borrowed. These can be credit cards, these can be auto loans. The largest and highest quality of credit is typically when someone owns their own home and has borrowed to buy it. There are also things, of course, like student loans, boat loans, all sorts of things, but these are the major ones. And as you build your credit, you are creating a credit profile and you're creating almost a reputation for how you manage your affairs. If you're paying your bills on time, you've shown other people down the road that you have repaid the debt that you agreed to repay. If you pay late or not at all, you've shown other folks down the road that you may want to borrow from that you haven't kept your contract. You haven't kept up your end of the bargain. So the way the credit cycle works is, you know, when you borrow money, you pay the loan back, you pay the lender. That lender reports you to the credit bureaus, the people who maintain the credit scoring model. And then those companies share it with new lenders. So if you're going for a new line of credit or for a home loan, the person that you're looking to borrow the money from, the institution or the bank, is going to look at your credit profile and see what other lenders who have taken a risk on you in the past have reported about your behavior with repayment. Another little question, true or false? Credit reporting companies like Experian, TransUnion, and Equifax decide whether a credit application is approved or denied. Now, these are the three major credit bureaus in our country. There are others, but these are the three that most lenders rely on for their information. And the answer to this is false. The credit bureaus simply provide data. They provide information that the lender then uses at their discretion to determine whether or not they want to approve or decline a request for credit. The credit agencies are like the libraries where companies check out credit histories if they have permissible purpose. So I just mentioned that the new lender will ask the credit companies the credit bureaus to report on your behavior with the prior lenders. And a permissible purpose is kind of a lawful reason for us to look at your credit. It could be because you want to open up a new account with us, or you have an existing account with a lender and they have reserved the right to periodically check to see how your behavior is with your credit profile to make sure that you maintain a good risk for them. You might look for new credit. You might be applying for a job, particularly one if it has sensitive data or information or security clearance. They might check your credit. Insurance companies like to determine if you're a good risk based on your credit profile, whether or not you're eligible for government licensing, a business transaction, risk valuation by an investor, or disclosure to other consumers. So these are permissible purposes. What is not permissible is, let's say I'm a lender, I'm a mortgage loan officer, and I'm just curious about my sister's credit. I want to know what she's been up to. I do not have a permissible purpose to look at my sister's credit. Now, if my sister decides to apply for a loan and choose me as her loan officer, then of course I have permissible credit. under that scenario, permissible purpose under that scenario. So what is a credit report? Well, a credit report is a report of your credit history. The bureaus, like I say, the three major ones in the country, they maintain a dossier or a file on you, and the lenders that you currently have obligations with report to them typically on a monthly basis. Some might be quarterly, but they report to them your payment history. Out of that history, they determine through algorithms what your credit score is. And each company has their own algorithm, so the scores might vary, but we'll talk a little bit more about that. So not to get too deep in the weeds, but this is what a typical credit report may look like. Section A is just your personal information, and it's important as we talk later on about checking your credit, that whenever you do check your credit, you want to make sure that things are correctly reported. If the addresses are wrong on your credit profile, that might be something you have to explain to a lender when they pull your credit, because it might look as though you may have misrepresented your current address on your loan application if it doesn't match your credit report. So you want to make certain that the information in your credit profile is accurate and up to date. Section B is your public record information. So this is kind of the biggies, the things that really get folks in trouble, like bankruptcies and foreclosures and short sale of property. They're going to be listed as public records because those occurrences are recorded somewhere, typically at the town hall of the town where the event occurred. Section C shows collection account information. If you're late with payments, that's one thing, but if you have a debt that you just never satisfy and it lingers out there, it doesn't go away very quickly or at all, but it will be listed as a collection account, which means that you still owe the money even if they've stopped chasing you down for it. And this is one of the reasons why it does show up on your credit report, because that creditor is hopeful that someday you're going to pay them. So they latch onto your credit report so that future lenders see that you have an obligation, and maybe the original lender has an opportunity to collect that debt. Section D shows your actual history. So this is for each trade line. Now, a trade line is your account. So if it's a credit card or a car loan or a home loan, those are each different trade lines. And each trade line will give a number of information. When you opened the account, how much you originally borrowed, whether or not you were the only owner on that debt account, what your monthly or quarterly behavior was to pay that loan back through the life of the loan, whether or not you have an outstanding balance, how much your payments are, et cetera, et cetera. Lots of information in that credit history section. And then section E is the last section, which is called the inquiries. Now, every time someone looks at your credit, it shows up on your credit report. And there are hard inquiries and there are soft inquiries. A hard inquiry occurs when you are actually looking to borrow money. So you go to a car dealership or you go to a bank for a home loan, they will do a hard inquiry, and that inquiry can have a negative impact on your overall score. How much of an impact is subjective? It depends on how strong your credit is to begin with. If you have very strong credit, an inquiry will have very little impact. If you have bruised credit, meaning you've had some late payments or a collection or two, then that inquiry will have a much greater impact. So this is all in the bucket of things to do to keep your credit strong. Limit your inquiries because each one has an impact on your score. The soft inquiry is for things like your car insurance. If you have an insurance policy, they may check your insurance annually to make sure that you're still keeping your obligations current. And that inquiry, because you're not applying for new credit, does not affect your credit score. Okay, now there are some changes that have happened recently. So you'll see the dates on this slide are a little bit outdated. These changes have come into effect already, and there are some new changes on the horizon that I'll touch on briefly. So back in 2022, medical collection bills no longer appear on credit reports. This was a thing that lenders saw all the time. Because we have insurance, and typically insurance covers insurance costs or medical costs, but there's a copay involved, we would have customers who would have their credit reports would be littered with very small past due medical bills, things like $30 or $40. And what these were in effect were copays that the customer didn't even realize they owed. They thought their insurance policy had covered the doctor's visit, and they didn't even give it a second thought. And we all know that we get tons of mail and tons of email, and we don't even look at it all. And sometimes those medical bills got lost in the shuffle. So it was determined that that really wasn't fair to ruin a customer's credit because they owed a $30 copay. So those no longer affect your credit score, which is a huge consumer win when that came out. Also, the new changes gave a customer an opportunity to fix any of those types of issues. So once it was brought to your attention, you had a chance to rectify it before your credit score was affected. And then finally, medical collections, meaning they tried to get it from you, they never did. That $40, $30 copay lingered. There comes a point in time where, you shouldn't be encumbered by that any longer because it was a medical debt, and they did start to waive anything under $500 in aggregate on the credit reports. So those were all good, positive changes. Coming up soon, in the next 12 to 18 months or so, the credit scoring model that lenders use is going to change pretty dramatically. And it's going to involve trended credit. And we touch on that a little bit in a future slide, so I'll get back to it. But there are some more changes coming in the credit system. Buy now, pay later accounts. Well, how do these affect your credit? A lot of the larger retailers, like the ones listed here, Amazon, Walmart, or Target, offer buy now, pay later options when you're on their websites looking to buy items. Well, these do afford flexibility. A lot of people get to borrow on credit without any finance charges and things like that. However, every time you do that, it is a new trade line on your credit. And we're going to talk about capacity later on, but whenever you have maxed out a credit line, you've charged your credit limit on your credit card, it does have a negative impact on your score. So if you have a lot of these little credit lines, because that's in effect what they are, and it looks like they're all maxed out, it has a significant impact on your credit score. This is a consumer convenience feature that has kind of evolved in recent years with consumer trends of buying online, et cetera. But the credit scoring model hasn't quite caught up to it. So you're being penalized for this type of behavior that isn't necessarily fiscally irresponsible, which goes back to my original comments at the very beginning of this entire presentation. It's not bad to use these things, but the credit scoring model will be negatively impacted. So bear that in mind. So this is a little bit of what I just alluded to with changes. So over time, there have been many, many, many versions of the credit score. The FICO is Fair Isaac Company. They created the modern credit score. And then the Experian, the TransUnion, and the Equifax, the credit bureaus that we discussed, use the FICO model and manipulate them to their business needs. That's why the scores vary a little bit between the companies. But the FICO is the actual core system that determines the FICO score. Now, again, there have been many, many versions. It kind of all started with FICO Classic back in the mid-90s or so. And quite honestly, the FICO Classic is one of the models that most lenders for mortgages in particular use that FICO Classic. And it is relatively outdated. And the biggest thing about it is it's a point in time. So if I pull your credit today and you just happen to have a large purchase on your credit card, like you bought a refrigerator last week, all I see is that large balance. Your behavior on that credit card may be such that you very rarely run a balance. But because you have this large purchase when I happen to pull your credit, it's negatively impacting your credit score. The new scoring models that, again, are going to come into play in the next 12 to 18 months by our current estimations, it uses trended data over the last 24 months. So it's going to kind of average out the spikes and valleys over the last 24 months to get what I consider a more accurate picture of someone's credit behavior. Now, the example I use of the refrigerator is a positive outcome. This could also have a negative impact outcome. And what I mean by that is, if I know that my balances are high today and I want to apply for a loan in 3 months, I might spend some real energy in paying down my credit balances during the next 3 months, so that when the lender pulls my credit 3 months from now, they see very low balances. Well, in the new system, that won't work because again, it's averaging out the last 2 years. So if I carry consistently high balances for a year or so, and then I pay them down in a 3-month period to better my score, in my opinion, it's not going to have that impact under the new model, because it's going to average it out, and that pay down will be diluted by the other months in that 24-month cycle. So that's a pretty big thing that's going to change the landscape of how we borrow money. Okay, so how do you check your credit report? It's a good idea, if you've never seen your credit report or if it's been some time, that you look at it before a lender ever does. So if you think you're going to anticipate a credit need in the future, you need a new car, you want to apply for a home loan, then it really behooves you to take a look at your credit report. And you can do that for free. Annualcreditreport.com is a consumer-facing website that we trust to look at your credit profile. You can also go directly to each of the 3 companies that we've been discussing during this presentation, and you can get your credit profile. Now, when I say you can get your credit report for free, you can get the history for free. The scores, however, are the property of each of the credit bureaus. So typically, to get a score, you do have to pay what many consider a nominal fee, like $7 or some such thing, to get the actual scores. But I would start with just the credit history. Make sure that that personal information is accurate, your addresses, workplace, etc. And then look at your trended data, look at your behavior. If you see that things are as you expect, always on payment, paying on time, or you see that you've had some issues, but it doesn't surprise you, then that should be enough. You don't really need to know your score. You just want to make sure that your credit profile is accurate. And then if there are issues with your credit and you've verified them by seeing it in print, then work towards resolving that. And you can always call anyone at Chelsea Groton Bank to get in touch with some of the folks here that can help you with some of the rules of maintaining a good credit score. We also offer classes like this on a recurring basis, so you can always get more information about keeping your score in good shape. Okay, if you do see something that you don't like on your credit, and I don't mean that you don't like, but that you think is inaccurate, then there are processes to try to get that repaired. And I would highly encourage you to do that well in advance of applying for any type of new credit. The reason I say well in advance is because sometimes this stuff takes a little time to get rectified and then to flush through and to be reflected in the credit score. So you want to get on these things as early as possible if you see an anomaly in your credit report. And all of the bureaus have a process in place to dispute or set a claim against what they've recorded as your credit. So that's the place to start, is with the bureaus themselves. And it's not enough to just do it with one bureau. If you see that Experian, on the Experian report that you went to their website to see, has a delinquency, odds are the other 2 do as well. So you need to take the extra effort to get it repaired on all 3. They will not do that legwork for you. So that's very important, because when a lender pulls your credit, particularly for a mortgage, they're going to pull all 3 bureaus and they're going to use the middle of the 3 scores, not the average, but the middle. So if you fixed it on TransUnion and your scores are TransUnion 750, Equifax 720, and Experian 710, they're going to use the Equifax at 720, and they never see the TransUnion, which is the higher score, because that's the report that you fixed that error on. So I hope that makes sense. Change it on all 3 bureaus. Okay, one thing to note, credit bureau reporting companies don't store criminal backgrounds, medical information, your buying habits, short of whether or not you're using credit, but they're not looking at what you buy or how often you're buying things. Your assets, the credit bureaus do not have a look into how much money you have or what kind of cars you have. And they don't store your credit reports. Those are recycled every time that you look at your credit. Those are not stored in aggregate. Okay, true or false? You must give permission for your credit to be accessed. What's everybody think? This is actually false. A lender has to have a permissible reason to pull it, like we said. But like with the insurance company, if they're doing an annual check, they don't have to call you and say, can we look at your credit? They can look at your credit because their permissible use is the fact that you have an account with them. I'm sorry, I misread the question. That's not what this question is getting at. You must give permission for your credit report to access, to be accessed. You do not have to give someone permission to pull your credit. They have to have a permissible purpose, okay? But they can't force you into letting them pull your credit. That's what this question is getting at. Now, just one more thing on that. If you want to borrow their money, you have to give them access to your credit if that's part of their underwriting criteria. Okay. The fact that you want something from them and you've applied for something gives them that permissible purpose if that's part of their stated underwriting criteria. You will never get a mortgage loan if you deny the bank the opportunity to pull your credit. So I hope that makes sense. Okay, some myths about credit reporting. We won't go into too much depth on each of these, but they're good to talk about. When paid, bad debt will go away. That's a myth. It will eventually, but it will affect your score for a very long time. It is much easier to, for lack of a better term, ruin your credit than it is to keep it consistent. The inertia definitely goes towards ruining it. When you make a mistake, a lot of things are involved. Number one, the thinner your credit is, in other words, you don't have a lot of credit, the bigger an impact any minor indiscretion will have. If you have a lot of credit over many years and many different trade lines, one little missed payment will be diluted by all that other good history. But if you're new to credit, you're a young person, you just took out a credit card and you make a late payment in the third month that you own it, it will devastate any work that you did on your credit report up until then. The credit reporting company denied me credit. The credit reporting company does not deny or approve anyone for credit. The lender does. I'm not responsible for those charges on our account. I'm not quite sure what we're getting at there, but you know, anything that's on your credit profile is truthful until you dispute it during the appropriate channels. But if someone marks you as late and you are in fact late, it is what it is. You've had that indiscretion and there's no way to erase that off your record if it is truthful and legitimate. A divorce decree separates joint accounts. It does not. The lender would have to drop you from an obligation through whatever means they determine to do that, if they will, but the divorce decree itself does not dissolve anyone from an obligation. It may assign different obligations to each spouse, but it doesn't relieve the other person from that obligation if they are on the actual borrowed account. Consumers must give their permission for a report to be issued. We talked about that. Requesting your own report and pre-approved offers harms your credit history. It does in the sense that it is an inquiry. I'm sorry, requesting your own report does not affect your credit history. You are entitled to your credit. The pre-approved offer means that someone has already offered to give you credit, to give you a new loan, and they've likely done a soft pull because again, they can't do a hard pull without a permissible purpose, but they're telling you that they've deemed you credit worthy, and that's likely a soft pull. There is only one credit score on every report. We talked about the fact that FICO is the credit scoring model, and each company that issues the information to the consumer tweaks that a little bit so the scores can vary. The other thing that we should talk about in reference to that is, consumer tools for credit have become very, very popular. These are things like Credit Karma, or if you have a Discover credit card, they offer a credit monitoring service. At Chelsea Groton, we also offer a credit monitoring service. These are a version of that FICO score, but it is not the most conservative version that we use when we're looking at mortgage lending. So you will see scores, and they will inform you about your general credit usage, but don't be surprised if when the lender pulls credit because you've applied for a loan, that score isn't lower than what you see on your tool. But what the tool is very valuable for is if you're monitoring it on a regular basis and suddenly you see it, sharply decrease, then you know something's going on. Either you missed a payment or someone maybe has gotten hold of an account of yours and hasn't paid it. There's something going on, and you should look into it. Okay, so how do you take care of your credit? Once you've kind of established it, how do you take care of it? Well, it's a lot easier to maintain it, like I said, than to repair it if it gets broken. So let's talk about some tips and tricks. True or false? The optimum number of credit cards for a strong history is 6. That's false. We have an idea of what the credit models are looking for to establish a good credit history. However, it isn't set in stone, and nobody truly knows what the algorithm will spit out. But by and large, 3 trade lines, and they can be any number of different things, although there are different qualities of credit, which we'll go into. But about 3 trade lines with a 2-year history is a really good start to really strong credit. Okay. When we talk about credit, how to keep a credit score high, the number of cards you have doesn't really matter, and that might surprise a lot of people. But the number of cards don't. It's the overall balance on all the cards compared to the overall limits that matters. So if you are maxed out on all the cards that you have, you are deemed a greater risk than if you have low balances on perhaps many more cards, because it shows that you're managing that debt within a low risk fashion. If you run into trouble, if you lose your job or something like that, you don't owe a whole lot of money at high interest rates that might create a spiral downward from that unfortunate situation of losing your employment. If you keep your outstanding balances to 30% or below of your available credit, history shows us that keeps your credit score pretty strong. So that means if you have $1,000 credit limit on a Visa card, you want to try to never charge more than $300 on that card or $330 on that card. That will keep your credit score healthy. If you have no credit, it doesn't mean you have good credit. And again, right at the start of this presentation, I talked about being fiscally responsible, and not borrowing money can be fiscally responsible because you don't owe anybody anything and you're living within your means. But again, this is a game that we've established, this credit profile. And if you have nothing for a new lender to sink their teeth into to see what your behavior is when you borrow money, they're less inclined to be the first person to lend you money. Okay, so what are the do's? Establish your credit report. Start building your credit. Always pay as agreed. When I say always, I mean always. I don't mean sometimes. I don't mean when you feel like it. I don't mean, only when times are good. I mean always. Every missed payment, no matter how insignificant it means to you, and it could be insignificant for a number of reasons. It could be insignificant because you only owe $20 and you're like, it's only $20. What's the big deal? That's one form of insignificance. Another insignificant is you're only a day late. Oh, heck, it's only a day late. But the computer model sees that you're late. It doesn't see how many hours or days you're late. It sees that you're late, so the impact is just as bad. So always pay as agreed. And if you're considering a purchase that you think is going to strain your budget such that you can't make your payments on time, delay the purchase. That's my best advice I can give you. Again, build your credit. So get a credit card, use credit, get a car loan. Even if you can pay in cash, maybe get a car loan and keep it for a year. Sure, you're going to pay some interest, but you're going to build your credit score. And that's important if you want to borrow money in the future. Demonstrate stability, meaning every payment gets paid on time, all that good stuff. Have a plan for your budget like we talked about. Don't overextend yourself. Put credit to work for you. You can use the system to make sure that once it's up there, it stays up there. And then share your knowledge. We're sharing our knowledge now. Tell your friends, tell your family, tell your children how to establish a good credit score. The world is against a lot of our kids and a lot of us when we were young. If you happen to go off to college on the very first day at the career fair at college, They have credit card companies offering you a credit card. Well, most kids that are in school don't have a job as well, or if they do, it's helping them pay for school. It's not giving them excess funds with which to go borrow money for consumables that they don't necessarily need. So educate your kids, educate your family members, and you know, the more people have good credit, the less people are getting taken advantage of by high credit rates and things like that. True or false? 0 is a perfect credit score. I think we talked a lot about this. That is false. We have to build our credit to be able to prove our trustworthiness. Okay, so what is the actual credit score? It's typically a 3-digit number. It's determined by an algorithm, which we talked about, and it is a reflection of how you handle your score. A perfect score is 850. I will say this, I have been doing mortgage loans for 29 years. My personal record, the highest credit score I have ever seen in that time, is an 816. And now if you're thinking to yourself, oh, my Credit Karma says I have an 870, well, again, that's a different model of that FICO score. The most conservative models that lenders use for home loans, car loans, put you between 350 and 850. And 850, it's impossible to get because you don't know what the algorithm is. Sure, you can pay every single bill on time, but it's looking at your mix of credit, how much credit you have available compared to other people. So it's a moving target. You just don't know. I will say this, I think we're going to get to the different tranches here. Yeah, I think it's on the next slide, so I'll reserve that comment. This is how your credit score is made up. 10% is new credit. In other words, if you just got a brand new credit card, that's a small portion of your score. Length of history is a larger portion. So the longer you hold on to your credit cards, the better. We encourage people not to close credit cards, even if you stop using them. Just cut them up or throw them in a drawer and don't call up and close the account, because as long as you have the account open and you have major payments on time, that length of history helps you. The minute you close a card, you lose all of that established history. Your credit mix, you know, you could have a credit card, you could have a car loan, you could have a student loan, you could have a mortgage. That mix adds to your credit score. The more diverse it is, the better. If all you ever have is credit cards, your score is not going to be as high as someone who has a better mix of credit. Your payment history is the largest chunk here. Again, every payment on time without fail, no matter how insignificant. And then finally is that usage. We talked about how much you owe versus how much you have available to you. Okay, Vantage and FICO, very, very quickly. FICO, we've been talking about this whole presentation. That is the actual scoring model that the credit bureaus have used for years. Vantage score is actually a newer score developed by those 3 credit bureaus. They got together and said, why are we paying FICO to use their score? Why don't we, as the industry leaders, get together and create our own score, which they did. Now, the issue there that they may not have anticipated is that these things take time to gain traction. And when we've been using the FICO scoring model for 40 years, a Vantage scoring model takes some time to get recognized. So they both exist, but FICO is the prevailing score for the most part. This is what I alluded to a few slides ago. This is where credit falls. Again, you know, 850 is the max, but you can't get an 850 really. But these are the tranches. Anything over 800 is top tier. You have no worries. And like I said, your credit won't be impacted as greatly by indiscretions. An inquiry, one small late payment won't damage your score too much because there's so much built up there. 740 to 799 is very, very good. 670 to 740 is kind of your mid-range. Some things will be closed to you, and we'll talk about that in a second. And then it goes down from there. When I say some doors will close to you, whenever you're looking to borrow money, and we'll use home loans as an example, you know, there's a whole vast product set, and the best credit borrowers get the best terms. As your credit erodes, some of those better terms are less advantageous. So if you can picture kind of doors in a hallway closing to you, and when you get down to the 580 range, there might only be one door left open. And because there's only one door left open, the terms for that loan are much, much worse because you have no other choice. So keeping your credit score keeps as many doors open when you go to borrow money. True or false? Paying a collection account will immediately improve your score. We talked earlier not to wait to get these things resolved right away because they will take time to be built into the credit model, and you eventually it will no longer impact your score, but it will take time. Again, it goes down quick if you miss a payment. It takes a little while to go back up. Paying a collection doesn't take it off your credit, but doing so will reduce the total amount that you owe. As a result, a paid collection will look better in the eyes of the lender. Yeah, if you're coming to me to borrow money and you owed someone else money that you did not repay, how am I going to look? Think about it in some other context. If I'm dating someone and I find out that they hurt someone else prior to our engagement, I might be wary about continuing my relationship with that person. Well, same here. You're looking to borrow money from me and you didn't meet your obligation with someone before me, I'm going to take that into consideration. So if you have a collection on your account, let's say pride got in the way. You canceled your cable subscription at an apartment that you had rented. The cable company didn't cut off your bill when you thought they should have. Now there's a $50 outstanding obligation that you just never pay on principal, and it haunts you for months and years. Well, now it's in collection, and somebody else looks at your credit profile because you've asked them to borrow money, and they say, well, geez, why didn't you just pay the cable company? So if you see that collection on your credit report, when you go to annualcreditreport.com, because of this presentation, go ahead and pay those collections. It won't have an immediate impact into your score, but down the road, you will benefit from having resolved that issue. Okay, some don'ts. Do not feel pressure to get a new card. Every single store now has their own branded credit card. So when you go to Target, when you go to Macy's, you will likely be offered a discount at the register if you apply for their credit card. A couple things happen when you do that. Number one, you get a brand new card. And with no history on that card, there was an inquiry for you to get it. Now it's a brand new line of credit. God forbid, because it's a new credit, they only give you a $500 credit limit, and your purchase that you're making at that counter is $350. With that purchase, you've already used more than 30% of a credit limit on a brand new card, and your credit score will suffer. If you have poor credit, it will suffer exponentially. So that's a real big no-no. The 10% off the purchase typically isn't worth the risk. That doesn't mean that you don't ever take advantage of those opportunities, but when you do it soberly. You know that you have strong credit. You know that the purchase you're making is not going to be over 30% of the amount of the credit that they are offering you. And you know that you're not going to make a large purchase sometime in the immediate future where that brand new card will have an impact negatively on your credit score. Okay, do not pay late. I think we beat that horse to death. Never once, if you can help it. Let YOLO get in the way of your budget. For those of you who are not familiar with YOLO or don't have teenagers at home, you only live once is what YOLO stands for. So when you're out and about and you see something that you really love, that beautiful purse or something, make sure it fits in your budget and that you'll be able to pay for it if you use credit in a responsible way. Don't just apply for any credit. I think we talked about, the example of the 10% off credit card. Do not carry a large balance. Try to keep your balances across all of your credit cards below 30% of the available credit limit. Do not close out old accounts. And we talked about that. The history is helping you even if you're not using the card. Do not just pay the minimum. A typical credit card, even for someone with good credit, carries an interest rate of 16, 18%. Now, you may get offers if you have strong credit for a 0% teaser rate, and that might be 0% for 6 months or for a year. And a lot of people like to open that card, transfer balances to it, pay the 0%, or don't pay the 0%, I should say, And again, that's fiscally responsible. Unless that card, which is brand new, has a limit of which you've already exceeded it by transferring those accounts. And that's not going to be 0% forever. It's going to go up. And when it does, it'll be 16 to 18%. If you have a balance on a card at 18% and you are just paying the minimum that you are billed, you will never, ever pay off the principal on that credit card. You must add to principal. You must pay more than the minimum each and every time you pay if you carry credit card debt. And multiple cards at once. We talked about that. Do not add a whole bunch of credit, new accounts. It will affect your score. It's okay to have a lot of trade lines as long as you're using them responsibly over time. And don't share your credit card information with anyone. That should be common sense for most folks, but fraud is evident everywhere. Okay, we do offer other classes if you got any value out of this one at all, and I hope that you did. We offer a budgeting class. We offer a credit repair class. So today we went into what makes a score and some good do's and don'ts. But if you have bruised credit and you want to make sure that you're taking the right steps to improve that score, take one of our credit repair classes. And then Welcome Home is our first-time homebuyer course. Even if you're not a first-time homebuyer, but it's been a while since you've borrowed money to buy a home, I encourage that course because a lot has changed in recent years. These are all free. You do not have to be a customer of Chelsea Groton Bank to take any of them. They are all listed on the calendar on our website at chelseagroton.com, and we encourage you to check them out and to join us for future classes. And I'm happy to entertain any questions that anyone might have at this point. My phone number, or I'll give you the number of customer care at the bank because they're the gatekeeper to all the resources that we have to offer. Is 860-446-4200, 448-4200. Again, that's our customer care, or www.chelseagroton.com is where you can find all of our class schedules and get a hold of me, get a hold of anyone else, any of our other subject matter experts. So if there are no questions, again, I want to thank you for attending, and I wish you luck with your credit profile. Take care.